On December the 14th, the second last day of the 2022 season of Daily Energy Markets podcast. We'll finish up the season tomorrow with Mike Muller and Christoph Ruhl. And then pack away everybody's Christmas stockings and head off for the festive season. Oil markets this morning trading a little bit down, 80.38 on Brent after breaking through that $80 mark yesterday, and seeming that this recovery, this climb back from knocking on the door of 70 has been reversed, and perhaps the momentum is in the flow of supply concerns now trumping demand destruction, which seemed to be the thesis over the last week. A big part of that question, I think, lies in China. And to be honest, I have to admit from this distance, I'm a little bit confused exactly what is happening in China. The general narrative, China reopening, seems to have a bit like the hopium of the Fed pivot. So China reopening is like a light switch. You turn it on and it's boogie woogie time. And the same with the Fed pivot. You switch it off and there's no more interest rate hikes. Albert Stromquist, principal at Landstrom Advisors, sitting in China this morning. Albert, brief us from your perspective the exact state of affairs in China, the reopening, the zero COVID policy, etc.
China is not reopening, but there are breathtaking changes, though, that have taken effect in the last week as well. The country remains closed, but life is turning toward normalcy. And it's going to be an interesting test of the country's ability to manage the pandemic as to how that trend toward normalcy evolves over the next several months. At this point, as you're aware, China has introduced a 10-point policy program last week, basically eliminating large-scale quarantines and daily testing of the entire population. In place of managed care on a spot basis, a household basis for people who have tested positive, letting the balance of the population resume life at some degree of normalcy. What that means, however, even according to the experts in China's own health center of epidemiology, is that China is expecting a huge surge in infection over the next 80 days or 90 days as these controls have fallen away. And their objective is to reach herd immunity. If you take into consideration that only 370,000 people in China have been infected to date, and that's a robust number, herd immunity suggests 60% of the population has been infected. That's what, 850 million people over the next 80 to 90 days, who they fully expect, are going to contract the virus either asymptomatically or symptomatically. And they're preparing their hospitals, their ICUs, they're expanding ICU capacity here, and also preparing specialized fever clinics for walk-ins from the street in order to try to manage this, and hoping that they will have sufficient logistics in place to do that. Obviously, what China is betting economically is that the pain of a herd immunity infection rate is going to be more than offset by a strong economic recovery thereafter. Because continuing the status quo indefinitely is just going to continue to drive the economy down and lead to nothing good. So that's basically where we are today, Sean.
Well, thank you for that. Let's go to, I was going to say the Black Forest of Germany or Kensington High Street, but no, it's Abu Dhabi and sunshine for Dr. Carl Nachley, CEO of Crystal Energy. Carol, today is the day when the Federal Reserve of the United States meets for the last time this year to once again would increase rates expectation for the seventh time this year, I think, but this time 50 basis points. All of the noise and the reporting after yesterday data that inflation is continuing on a downward trend in the US. What's your outlook, not so much for the Fed decision, but where they go from here into the new year?
Good morning, Sean. I mean, there was lots of overexcitement, I would say, about the data that appeared yesterday with the slowing down of the inflation in the US. And this is not just a big week for the US, especially for their central bank, the Federal Reserve, but also for other central banks in Europe, the ECB, Bank of England, etc. So we're going to see like a souffle of central banks meetings and their decision vis-a-vis the interest rate. But it was for me a premature celebration because yes, going for 50 basis points versus 75 is perhaps a reason for some to celebrate. But don't forget, we are still dealing with inflation at record high compared to several decades. So we're still really in the red zone territory. Yes, we are seeing a slowdown, and that's what you would expect because high prices, high commodity prices, and also the supply chain bottlenecks, they were going to ease over time, especially with this aggressive monetary policy that we are seeing. But this does not mean that the central banks are going to say, you know what, we're going to stop now and watch and observe. They still have a long way to go, I would say, to achieve their targets. And that's why we may see a little bit of more leniency towards a reaction to market data, but it doesn't mean it's going to be a U-turn. We're still far from seeing a change in a significant change in the policy of central bankers.
It'd be interesting to see where, as they say today, the big news on the dot plot, the famous outlook for where the interest rates are going forward. The other big story, of course, in the world impacting energy markets, James McCallum, CEO and chairman of Exergy Group, professor of energy, Strathclyde University, is in Europe, and its energy embargo on Russia, which just came into effect on the 5th of December with the price cap. Your thoughts, James, on the landing of the European embargo and the landing of these yet another layer of sanction on Russia and its likely impact on the overarching equation?
Well, I know I've commented before on this, Sean, and I'd maintain the position which I took previously on that, which is that I think the embargo will have little effect on the amount of Russian oil which is currently reaching the market and will continue to reach the markets. There has been some commentary in recent days around the insurance aspects of Russian vessels and international vessels coming out of Russia with that oil. But to be honest, I personally believe that where there is a demand, there will be a solution found for that oil to flow to markets like India and continue into China. The question is simply, how that demand will hold up in terms of the changing market dynamics at the beginning of the year. I think Carol is right to call a cautionary note in as we go into the first quarter in terms of, we might have a short-term festive season party just now, but it's going to kind of feel cold in January, as it always does, and that will flow over into the markets. And I think that is the one thing which will affect. As far as the price cap, yes, I think the countries that will adhere to that and acknowledge that are already adhering to it and acknowledging it. But the world needs that Russian oil to find its way to the market if the prices are to remain at the levels that they're at just now, whether that's $80 a barrel or 85 or 75. If that oil disappears or was to disappear, we would see a significant hike in prices. And I just don't think that's going to happen into the first quarter.
Albert, the question that is emerging in China, and a similar question that's emerging with the central bank monetary policy makers, is on the Fed side, it's whether they have the stomach to sort of stick with this robust tightening, even though it could trigger recession and further unemployment. The same question I have for you in China. This 10-point plan to reopen, to sort of move away from zero COVID. Does the Chinese government have the stomach for that, given the possible cause and illness and perhaps death, as we've seen in other parts of the world when Omicron has and the COVID virus has run wild? Will it relent and go back into a lockdown posture? Your thoughts for the sort of first few months of the year ahead as we go into the, you know, what is the Chinese New Year in end of January, a time in which the, as it's called, I think, the biggest migration of people on the planet?
Well, I mean, of course, Sean, there's the potential to revert to a quarantine mindset if things go very horribly south. But that's not, there are no good answers fundamentally for the government right now. To continue to move sideways or continue to spiral down even under a quarantine system is not the answer they're looking for. And I think they have steeled themselves against the consequences of a rapid expansion of the infection here over the next couple of months. At least at face value, that's the message that's being disseminated to the population. Now, the all of this is kind of a turkey shoot until we see how it actually plays out. But I think yesterday, the central bank and the government have announced a new round of stimulus. To support the economy, which means continuing low interest rates in China and national government level stimulus to Chinese industry. So they're moving in the right direction, I suppose. But this is all new. This is all uncharted water for them.
Carol, the upward motion in oil prices in the recent days, and on the back of this lower inflation call data reporting, and weakening dollar as a result, seems to be giving oil somewhat of a lift. When you put all of these factors together, we've had a few statements by OPEC Plus in recent days that we were right to make the decision we made in October. Your thoughts on that narrative of what has transpired and where that leaves OPEC Plus decision making going into the new year? Is this a balanced market as OPEC strives to achieve, or do they need to take action to address any imbalances that still exist?
Maybe we can find the answer at the moment in their monthly oil market report, which was published this week. And you can see that, okay, not many assumptions have changed. Actually, it's pretty consistent with what they published last month. So it seems that their views of energy of oil markets going into next year have not changed. But when you read carefully the report, you can sense a bit of more optimism in terms of the outlook for next year. So you can, for example, they put great emphasis on the Chinese recovery, though they do repeat and they say that they are cautiously optimistic. I'm not quoting them verbatim, but this is the kind of impression that you get from that report. Interestingly, they seem to put greater emphasis on the positive outlook for demand than on the negative outlook for supply, particularly when it comes to Russia. For example, if you look at what they have an assumption for Russian oil loss for next year, it's under 1 million barrels a day, which is significant, of course, or around 800,000 barrels a day, but it's more than less than half than what the IEA, for example, forecast in terms of loss of Russian supply for next year. So in that respect, I don't think we're going to see any significant changes in OPEC Plus policy. We'll have to wait and see, because there's a geopolitical factor, which is the other wild card that they highlight in the report. And there they say that, for example, they make the assumption that the situation is not going to get any worse. Whether the war, does that mean that they are making an assumption the war is going to end anytime soon? I don't know. But overall, if I take all these, economic outlook, the China factor, the supply losses from Russia, potentially from Russia, plus supply increases from elsewhere, as well as the geopolitical uncertainty, I feel like on balance, we should not expect a significant change in OPEC Plus policy at the beginning of next year. But don't forget, they are continuing to monitor the market on a monthly basis, and that might change their decision drastically and rapidly.
James, the other sort of big story about supply and supply concerns is one, because the US oil production has not returned to pre-COVID levels. And we had the US energy envoy, the Biden administration energy advisor, Amos Hochstein, actually giving a sort of schoolmaster sort of warning to the IOCs this week, that calling it un-American that they weren't investing in new capacity. And ExxonMobil then came out and announced that they were going to be buying back $50 billion worth of shares in the next 2 years, and sort of defying the call from the White House to put some of that money in the ground. Your thoughts of where that dynamic goes at the end of this year and into the new year?
Well, I mean, so you referenced the ExxonMobil position. It's, you know, the US oil production has become a big company game now. Over the course of last year, we've seen consolidation of several of the smaller companies into the bigger oil companies, and you've seen the bigger oil companies, the big IOCs, as you referenced them, take control of the reins as regards what happens there. In no small measure, as a consequence of the fact that the smaller mom and pop companies just simply can't access capital, you know, and the capital sits with the bigger IOCs, and they will continue to mop up, you know, sort of ideally priced smaller producing companies in the basins, et cetera, et cetera. Now, having said that, you know, over the course of the last year, we've seen a slow but steady rise in terms of the number of rigs which are operating in the US producing basins, you know, up from start of the year about 450 up to about just a little over 600 now. Now, that sounds a lot. It's not a lot when compared to the 2014-15 figures of around 1,500 rigs operating, you know, at that time. But nevertheless, it's significant. And interestingly, yesterday, in terms of that world of positivity in the space that we're talking about here, you know, you saw a jump in Halliburton, Schlumberger's share prices of around about 3 to 4%. So clearly there is a level of optimism there, which is above the level of optimism which is the wider markets are responding across the sort of like the Dow, the wider energy indexes, et cetera, et cetera. There was a kind of roughly about a 1% rise yesterday. So the dubs are winning out, back to Carol's argument at the moment, on the data that we're looking at. But within that, the service companies, the Halliburtons, the Schlumbergers rose 3%. One other thing which is worth noting, Sean, is that one other major IOC story that has unfolded over the course of the last year, and I watch with real interest next year, is that the big hydrocarbon producers, or the companies committed to a hydrocarbon-based strategy as opposed to an energy diversification or energy transition strategy. And principally, that falls into a US IOC supermajor versus European supermajor argument, have won out in terms of that share price. So when ExxonMobil are buying back their shares, they're buying back shares which have risen over the year around about 65% on the year. Compare that to the BPs, the Shells, the Equinors, the Totals, which are half that figure. So clearly a very strong feeling in the United States that oil and gas, conventional oil and gas production, very much going to be a part of the mix going forward, and they see their super majors as playing a very significant role in that. So that flowing through to the share.
Albert,
John,
I think slow but steady.
Yeah, can I just make one point about
please.
investment? And in the US, because American, for me, a bit too much over the top. You know, we forget that investment is affected by cost. Like when you commit capital expenditures, these are huge commitments today. And we talk about inflation, but we only think about consumers. What about investors? You know, the cost of capital, that has also increased. We cannot only look at investors, say that today high prices, oil prices are high, therefore we should expect them to invest more. Also should take into consideration the cost of capital, which has increased a lot given the impact of inflation, but also the other dimension is expected prices. So that tells you a little bit about what how the industry is seeing oil markets going forward.
Yeah, but how do you square that circle with $25 billion worth of share buybacks? I mean, that's I mean, that challenge of a higher cost of capital, but yet you're giving capital, such large amount of capital back to shareholders.
I mean, they're trying to capitalize on the high price today. But again, when you talk about investment in order to increase output in the future, that's a bit different equation. So we cannot say that they are driven by high prices today, therefore they should invest more, therefore they should produce more. We should also take into consideration the cost of investment. So that's what I want to highlight, because we seem to think of inflation only from the consumer side, but we forget it's also increasing the cost of doing business, including for oil companies.
Albert, this week, the Chinese government, the annual Central Economic Work Conference that is chaired by President Xi Jinping and the other top Chinese officials, which essentially sets out the economic roadmap for the year ahead. What's your expectations from that? It needs to happen before the end of the year, but do you expect more stimulus? What's your views of what they could deliver to support this reopening?
Well, they'll deliver stimulus for certain. There isn't a lot of optionality, though, beyond that. The demand, energy demand is still suppressed by the transportation industry, first and foremost. And the transportation industry is the canary in the coal mine, right? In terms of the health of the economy today. And that's not going to change until the borders reopen, and until people's willingness to take risks and travel changes substantially from where it is today. Remember, overland transportation by motor, personal automobile is off 86% compared to pre-COVID. Air transportation is off 60% compared to pre-COVID. Right? So the outlook that have been published by some quarters here for China to realize a million barrel per day gain in 2023 really reflects on the transportation sector and the airline industry first and foremost, which would in a normal world account for 600,000 barrels a day of that gain. So watch the transportation.
And we've seen the import numbers grow during the course of the last few months. It's a steady upward tick in China imports. Is that a reflection of demand and growing consumption?
Not so much, really. The refinery utilization is still deeply suppressed compared to the pre-COVID days, by some estimates running at 60% of capacity. So where are those additional barrels going? They're going into strategic storage, first of all, and they're being re-exported in the second instance, and then being run through surplus refining capacity and exported as product for additional revenue, for which a large quota increase has been given to refiners for the year end 2022 and beginning of 2023. So we're looking perhaps at a 20 million barrel quota for product exports here in the next month or two.
Let's go to the survey question, which again points towards the Fed decision today. The oil markets have already priced in Fed peak inflation and peak rate hike cycle. Agree, disagree, that the markets have already priced in, and unless we have some kind of unexpected development, that the oil markets have already absorbed this rate cycle, and we are looking beyond. Carol, I wanted to get your thoughts as we go into closing comments here about obviously where you think the dot plot of the Fed goes, and does it matter? A year ago, the Fed put a dot plot. I think it was going to see a 0.8% rise in interest rates in 2022. It ended up being something like 400 basis points versus 80 basis points. So the dot plot can be fairly irrelevant, but at the same token, some kind of guidance. As we look into the end of the year, we go on break. How do you think the next 3-4 weeks of the play out, winter and so forth?
Oh my God, that's a very big question, but I'm going to
Yeah.
limit it only to one thing in terms
Yes.
of the economic outlook.
Please.
So economic outlook so far does not look quite encouraging. But we have kind of absorbed the idea that we're heading into an inevitable recession in many key economies around the world. So that risk, and it's not anymore like a minor scenario, but it's a reality in many places. So
but you don't see that in the equity markets very much. The equity markets still remain quite bullish.
No, but you see volatility in equity markets. I mean, try to chase them on a daily basis. You kind of go crazy. So there is volatility there because of this kind of uncertainty. However, what I was going to say is that there is an increasing kind of perception that maybe after all, the Fed will end up having a soft landing and not really causing a disastrous recession and a collapse in economic growth. So that's the kind of mood that we see today. It's not like entire change of scenario, but the fact that the outcome of the Fed and its policy will maybe able to nail a soft landing.
James McCallum, I'd welcome your closing thoughts for the rest of the year, and particularly with your expertise and familiarity with the UK, which seems to be going through yet a whole series of challenges, and most recently now 100,000 nurses apparently to go out on strike, along with a bunch of others. And yet the sterling has recovered like a rocket, which would seem to indicate great optimism for the outlook of the UK economy. So those two things just seem incongruous. I welcome your closing thoughts on the outlook for the UK economy.
Well, perhaps incongruous is the word of the year, Sean. I think that's a good one to throw in there. Just picking up on Carol's point there, which is interesting around the volatility point. The volatility in the equity markets at the present moment in time is driven by very low volumes of trading. But interestingly, as a consequence of that, what that says to me is that there's quite a lot of fence sitting going on as people are sitting waiting to see what comes out at the back end of the year. Significantly, the S&P 500 sitting at above 4,000 at the present moment in time. And I think halfway through the year, you wouldn't have believed it would have got to that point again by the holiday season. And yet there it is. The UK equity markets have been very stable for a very long time. If you're taking a look at the FTSE, very, very stable throughout the course of the year. And I think that comes down to the fact that that the UK, for whatever reason, back to your incongruity, has sat there and felt that it's going to win through this post-Brexit argument if only the government could sort of settle down and find some degree of stability in terms of who actually takes us there. We are in for a major winter of discontent in the UK. There is no doubt about that, and it's a direct response to the UK government's failure to address public sector needs against a high inflationary environment. Now, interestingly, the words which are coming out in the discussions are an urging of caution over a slowing down of that inflationary impact on the economy. I'm sure Carol would be quick to respond to the fact that it's far too early to call that right now. I think we're seeing some early settlement on some of these strikes, and I hope we continue to see that. But it is, I think the first quarter of next year is going to be extraordinarily interesting. Back to Albert's point, I think China is in for a very, very harsh first quarter in terms of the impact of the virus as it sweeps through the population. And let's not forget, coming back to the UK, that we had a precedent of this. We had a precedent of a government that sought herd immunity and backed away when the consequences of it were just so impactful on the economy. And I really do wonder how China will address that, particularly where they have such a tight family unit through the generations. I don't know what that means. So for me, I end the year with a degree of optimism. I hope it sounds like that. I'm not sure it does, but I end the year with a degree of optimism as we go into the first quarter, because I think many of the moving parts are settling down, and we can work with that. And I think that's what we're seeing in terms of the markets. I think that's what we're seeing in terms of the oil price. I think OPEC and OPEC Plus have maintained their position in terms of being able to address the price where it needs to be. And I think particularly Saudi Arabia and the United Arab Emirates will maintain a leadership position going into the first quarter. If stability exists, they will position the oil price where it needs to be. And that won't be impacted by the US super majors, as you touched on earlier on, because they're busy just trying to work out what to do next.
Let's get the survey result and give Albert 100%. Crikey, I haven't seen that before. That's always a bad question when you get that dominating an answer. So naughty Sean for having a bad question. Albert, I wanted to we talked obviously through the half hour a lot of the internal China dynamics. I wanted to get your sense of the external as we end this year. It would seem better than expected. China's posture, just been in Saudi Arabia, engaging all of their critical allies in the Gulf, had the G20 meeting in Indonesia, met with Biden. Everything seemed to be relatively positive. And so despite the tensions with Taiwan earlier in the year and the position vis-a-vis Russia's invasion of Ukraine, China's and President Xi's external posture seems to be less fractious than where we started the year. I'd welcome your thoughts on that, where China ends the year with external posture.
But remember, until the end of October, President Xi had not traveled abroad for almost 3 years. So he has made a very strong gesture now to re-engage face-to-face with the world on their home turf. And I think that's an important development. Equally, he and his government have turned away from the Russian relationship, or are turning away. Yesterday, they announced that they would refuse to supply high-end computer chips to Russia, who had applied for import of some China's best chips, their Intel-compatible chips. That's not going to happen. So that in itself is very telling. There appears to be an effort here to re-engage with the ASEAN countries and provide some reassurance that China's intentions are not hostile. There was certainly an impression that they were going in that direction. So he's trying to diffuse that. And hopefully this kind of engagement is going to continue to assuage some fears and provide a better working environment to deal with China as it reopens.
Okay, well, we will have to leave it there with Brent trading a little bit down this morning at 80.38 and we'll see whether that upward momentum continues this week. We thank our very capable analysts, James McCallum, Dr. Carol Nachley, and Albert Stromquist. Really great to have you guys through the year as we now come to our break. I wish you all a very happy festive season and look forward to kick off the year all together on January the 11th, when all of you will hopefully be participating with us, where in one day we will go around the world with 50 analysts giving us their perspectives from the ground, starting in China early doors and ending the day in Mexico and Venezuela 12 hours later, for a very unique global perspective, crystal ball outlook for the year ahead. So and you really look forward to seeing all three of you back on that day, and all of our other capable commentators. Thank you so much. Merry Christmas, Happy New Year to all of you.
Thank you, Sean, and the very best wishes to you all. Very, very best wishes. Bye-bye.
Merry Christmas, Happy New Year to all of you. Okay.